So now we come to a stage of funding by angel investors. Who's an angel investor? An angel investor is a high net worth individual that invests his or her own funds. High net worth is fairly precisely defined by the Securities and Exchange Commission of the United States. $1 million of net worth, excluding primary residence, and or $200,000 or more in annual income as an individual, or $300,000 of income as a couple. So angel investors typically will invest in local startups. They will invest at early stages of a startup, and therefore they will be investing because they will be investing in early stage, which means high risk, which means an expectation of high returns commensurate with the risk that they're taking. So the angel investment industry, if we can call it that, is relatively large. As you can see, Q1 of 2018, $3 billion, $4 billion invested in approximately 5,000 startups. So $4 billion invested in 5,600 startups approximates to about $700,000 of investment on the average per startup. That's the kind of size of the investments that we're talking about here. So to understand angel investments, we need to understand a few concepts. Pre-money valuation, post-money valuation, the investment amount, dilution we talked about, and something called vesting. So let's cover those. So the definition of pre-money valuation is inherent in the word pre-money. That is the valuation of the company prior to an investment being made. And valuation is the negotiated value in dollars of the venture at any given time before an investment is made. So as you can see, pre-money valuations have been going up dramatically, and some people believe that this doesn't bode too well because there is no compelling reason for pre-money valuations to go up for similar companies. Some people argue that it's becoming easier and easier to form a startup, and therefore higher valuations are justified because the risk, almost by definition, is being reduced. So something to think about. And here is the pre-money valuation associated with the series of consecutive investment cycles. And as you can see, as the risk is presumably getting decreased as time goes on, the valuation of the company is increasing in a commensurate manner. So post-money valuation is also very simple. It's the pre-money valuation that the parties agreed upon plus the investment amount. So it's post after the investment is made. So the formula for ownership by outside investors is the dollar amount that's invested divided by not the pre-money valuation, but the post-money valuation. So that's the percent of your company that outside investors are going to own, having invested a certain amount of money based on the pre-money valuation plus the investment, which is the definition of post-money valuation. So let's, for those of you who may have watched Shark Tank, Investor A says, I'll invest $50,000 for 10% of your company. And Investor B says, I'll invest $100,000 for 20% of your company. Assuming all else is equal, which is the better deal for the founder, it looks like they should be about the same deal, 50,000, 10%, 100,000, 20%. But if we calculate the pre-money valuation that Investor A is assigning versus the pre-money valuation that Investor B is assigning. So first for Investor A, $50,000 for 10% of your company. So the post-money valuation is $500,000. And the pre-money valuation is $5,000, $500,000 minus $50,000, $450,000 in this case, 450. Here, again, the post-money valuation is $500,000, 100,000 divided by 20%. To get to the pre-money valuation, we subtract 100,000 investment from the $500,000 post-money valuation. So investor B is assigning a $400,000 pre-money valuation, whereas investor A is assigning a $450,000 pre-money valuation on the company, and therefore investor's A offer is better than investor B, all else being equal, because it gives a higher pre-money valuation to the company. So there are calculators that we can make available to you that you can use to vary the investment amount, the percent of the company, the post-money, pre-money, etc. There's also online calculators at the address that's given here, with which you can do a little bit more sophisticated calculations. And to read more about pre-money valuation, you can go to the following site and take a look. So the way to approach the angels is rather standardized. So angels typically form angel investment groups. So for example, the one that I belong to in Tucson, Arizona has about 130 members. And there is a website and a standardized application process where you submit an executive summary and a pitch deck. You go to a screening committee meeting, and approximately 1/3 of those who make it to the screening committee meeting are invited to our dinner meetings. That happens once a month, at which time you give a presentation and go through a question and answer session. And typically 1 out of 2 that come and present to our dinner meeting gets some type of funding from our group. So the approach, even though being referred is a good thing, but it's not necessary at all, because there's a very standardized online procedure to approach the typical angel investment group.